Think all investors are financial wizards with deep pockets and even deeper wisdom? Think they care about your vision as much as you do? Not so fast. In this episode of An Acquired Taste, we're blowing up the biggest myths founders believe about investors and saving you from painful and potentially costly mistakes. It feels like there is quite a bit of information, material, conjecture online about how investors operate, who they are, what their personas are like. And there's probably truth to most of it. Some of it, though, I think is just wrong and probably just grouping them all together incorrectly. Number one is I think there's this belief that investors, especially institutional investors, are super smart. I mean, maybe they're smart. I don't know that that's necessarily demonstrated in the way that they invest, because a lot of them just try to match patterns. They just try to look at what other successful startups have done, how they've been successful, and does your startup, does your company look enough like that successful company of the past to invest in? You'll have junior associates that are vetting your decks, meaning that the actual decision makers may not actually see your deck, may never even flip through it. For as much as you want to believe this is a super sophisticated process full of brilliant people, that just isn't the case most of the time. You need to know that. 98% of you who watch these videos are not subscribed to the channel. If you like the content we're creating and you want to support the channel, please consider hitting that subscribe button. Back to the episode. This next mistake or misconception about investors is that they're venture capitalists when they're really acting like bankers. This is something that has really irritated me over the last 18 to 24 months, watching people call themselves venture investors while acting like a banker. They want all of the upside of your venture scalable company, but they want the risk of a bank loan. And this is nonsense. It is not what the asset class is based off of. They want the upside. They don't want any of the mess of your startup, any of the heartache of trying to make something from nothing. They do weird things like wanting to understand how you're going to make a profit at the pre-seed level or at the pre-seed stage. They start asking you about your exit strategy at your Series A fundraising. Like, this doesn't make any sense. This is not what venture has been based off of for the last, 100 years. I don't like this trend. I don't appreciate this trend. And if you find yourself talking to somebody who's talking in these terms or speaking to you in these terms, they're not a venture capitalist. They're a tourist. Get out of there. One mistake that founders make all the time is looking at investors as wallets or just the check, that the total sum value of partnering with this investor is the cash they can provide to your company to operate and to grow. The best investors are always going to bring more than just capital. They're going to bring their networks. They're going to bring their credibility, their experience. They're going to be willing to engage with you in tough conversations. They're going to offer you critical feedback when you need it. If all you're getting out of investor is a check, you might be putting the wrong people on your cap table. Always, always, always look for investors that can be strategic as well as back you financially. The last mistake I want to mention is when founders look at investors as one big monolith, that anybody who invests in startups is the same kind of investor, that they have the same playbook, that they look at investments the same way. And that just isn't the case. Institutional investors, venture capital funds, usually have really tight theses. They have a playbook that they run. It probably feels a little antiseptic. It may even feel formulaic. That's not always the case, but it's often the case. Family offices, they may be investing just based off of how they feel on the Tuesday you happen to walk in the office. There's no set timetable for investment. There may not be a certain allocation of money they're willing to put towards companies of your type in your market at your stage. They just invest when they feel like investing. And then there's angel investing or angel investors or high net worth individuals. And that's a total crapshoot. You have folks that want to write you $5,000 checks into $1 million round. And then you have other people that might want to take the entire round by themselves. And then you never hear from them again. You just don't know. So you have to understand not all of them are created the same way. Not all of them are going to treat this process the same way. And not all of them are going to look at your startup the same way. So there you go. Hopefully we debunked some of the myths and misconceptions about investors out there. Some of them are brilliant. Some of them are dummies. Some of them will be great partners and some of them would be a disaster. So make sure that you're picking your investors as partners and doing it wisely. Thanks so much for checking out this episode. As always, like, comment, and subscribe, and we'll see you next time.